Welcome back to the Deep Dive. Today, we're doing something a bit different. We're skipping the usual prepared remarks, those polished corporate statements,
Right?
and we're diving straight into the Q&A from UnitedHealth Group's Q3 2025 earnings call.
That's often where you find the real story, isn't it? When analysts push back.
Exactly, because this is where you hear the unscripted answers, where executives have to defend their plans, and frankly, the tone this time around. It really suggests a major realignment is happening.
That's right. And our mission today is pretty straightforward: to figure out how this healthcare giant is actually planning to manage these historically high medical cost trends we've been seeing.
And more than that, what specific, sometimes maybe even painful strategic moves they're making right now, particularly in UnitedHealthcare and Optum.
Yeah, those two core segments. And you mentioned the tone, the level of detail they gave when analysts really challenged them on things like margin recovery or network changes, capital strategy. It felt, well, unusual.
It really did. This wasn't just going through the motions. It felt like an admission that, some things need fixing.
Okay, so where should we start? Maybe Optum Health? It's been the big growth engine, but it sounds like they're tapping the brakes now, focusing on discipline.
Let's do that. Optum Health.
Precisely. The executives basically admitted their growth strategy, quote, strayed during that period of rapid expansion.
Strayed. Interesting choice of words. Meaning what exactly? They took on bad risk.
Essentially, yeah. Risk that maybe wasn't managed properly or didn't quite fit the core model. So the focus now is, and they use this phrase, getting back to the basics of value-based care, VBC.
Right, VBC. Where they get paid a set amount for a patient's care, and they're on the hook for the outcomes and the costs.
Exactly. Full accountability.
That reframing seems really key. So structurally, how much of Optum Health is actually operating under that VBC model right now? Do they give numbers?
They did, finally. We got a breakdown.
Right.
So Optum Health revenue currently sits at 65% VBC.
Okay, the majority.
The majority, yeah. Then 15% is still traditional fee-for-service care delivery. And the remaining 20% comes from services they provide to other payers and employers.
And crucially,
Crucially, 2/3 of that big VBC book of business serves UnitedHealthcare itself, the parent company.
so that vertical integration is still absolutely central.
It's the backbone, no question.
Okay, now here's the number that really jumped out at me, signaling this discipline is serious. They expect Optum Health VBC membership to actually shrink.
That's right, shrink by approximately 10% in 2026.
10%. They're deliberately choosing discipline over just adding more members. That sounds, well, pretty radical for a company that's always been about aggressive growth.
It is radical, and it really confirms they're intentionally shedding risk that's either unprofitable or just not aligned well. That's specific, too.
How specific?
Talking about actions like exiting over 40% of their PPO footprint.
40% of the PPO footprint. Wow.
Yeah, which translates to about 200,000 lives exiting the Optum Health VBC model in 2026. They are, pruning the garden, so to speak.
Okay, pruning the garden to achieve what sounds like a massive margin goal. Didn't they put a number on that?
They did. The long-term target for that VBC segment is 6% to 8% margins.
6 to 8%, compared to what they expect for 2025.
Compared to under 1% for VBC margins expected in 2025.
Wow. Under 1% now, aiming for 6 to 8% long term. That's a huge leap. That must involve some difficult conversations with providers. How are they planning to pull that off?
Well, the official line is focusing on clinical quality, better integration using their tools. But yes, that jump is enormous.
Yeah.
It implies a pretty significant overhaul of how they operate internally.
And they have to do all this while navigating some major regulatory hurdles, right? Like V28.
Chief among them, yeah. V28 is a big one.
All right, for listeners maybe not tracking every Medicare Advantage form, V28 is that regulatory update, kind of controversial, changed risk adjustment, essentially cutting government payments starting this year. How is Optum Health mitigating that specific financial hit?
They're being really aggressive on the contracting side. Executives said they're close to getting 90% of their value-based payer contracts locked down for 2026.
90% done already.
And the goal there is to offset half of that V28 headwind, which is billions of dollars, remember, just through better contracts, adjusting benefits, and getting what they call appropriate rates.
So making up for the government cuts by basically being smarter, maybe tougher in negotiations, and how they manage patient risk.
You could put it that way. Forcing clinical excellence, they might say. Using data, managing risk tightly.
Okay, let's talk about that internal intelligence piece.
Hmm.
While Optum Health is going through this clinical discipline phase,
Hmm.
what's happening over at Optum Insight, the tech and data arm? Are they slowing down too?
No, actually, quite the opposite. Insight seems to be where the real acceleration is planned.
Ah, interesting.
They describe the shift there, moving from traditional services towards, and this is their phrasing, AI-first services, then to products, and eventually to platforms.
AI first. So the investment there must be pretty significant.
Massive. And they
Yeah.
didn't just talk concepts. They gave some
Mhm.
specific product results to back it up.
Okay, give us the highlights. What were the big aha moments from the Chief Digital and Technology Officer on AI?
Well, two really stood out. First, they launched something called Optum Real. They billed it as the, quote, first real-time platform for claims and reimbursements anywhere in the industry.
Real-time claims. That tackles a huge administrative headache in U.S. healthcare.
A massive one. And second, they talked about Optum Integrity One. That's an advanced AI auto-coding tool.
Auto-coding. And did they give metrics on that one?
They did. And this is pretty stunning. They reported a 73% productivity increase for ambulatory outpatient claims coding using this tool. 73%. That's staggering. Is there precedent for that kind of jump in healthcare tech efficiency? What does that mean practically? Fewer human coders or just handling way more volume?
Good question. They framed it more as enabling their existing staff to handle growth and increasing complexity, especially with more specialty claims. But the bottom line financially is clear. It could significantly lower the admin cost per claim.
Makes sense. Any other AI examples?
Yeah, they also mentioned Crimson AI. That's an AI-first clinical analytics platform. And they cited an average return on investment of 13 to 1 for the provider systems using it.
13 to 1 ROI. Okay, that's the kind of number you need to justify the heavy investment strategy they seem to be pursuing.
Exactly. They clearly believe these AI and tech investments are absolutely critical for getting back to double-digit growth, specifically starting in 2027 after this necessary slowdown in 2026.
It's like an acceleration strategy, but it looks like a cost center today.
That's a good way to put it. Investing now for the payoff later.
Okay, let's pivot then. From Optum's internal shifts to UnitedHealthcare, the main insurance business. Because it sounds like executives there are pulling just about every aggressive pricing lever they can find.
That's fair. Starting with the commercial segment, employer-sponsored plans, margins there dipped below what they expected.
Right. So what's the recovery plan? They have that long-term target range, 7% to 9% margins. How quickly do they get back there?
Well, not until 2027, according to their projections. For 2026, the expectation is still about 150 basis points below the low end of that range.
150 basis points, so 1.5% short still in 2026.
Correct. And that's despite pricing actions based on assuming an 11% medical cost trend.
11% trend. So that confirms costs are still running really high in the employer market. Utilization isn't really dropping off.
Seems stubbornly persistent, yeah.
Okay, but the real shocker, I think, was in the Affordable Care Act markets. The ACA exchanges. This felt almost like hitting the reset button with maybe a sledgehammer.
Sledgehammer might be right. They've filed for rate increases in almost all 30 states where they participate, averaging over 25%.
Over 25% average increase. Wow. Is that basically signaling they want out of the ACA business?
Well, they're signaling they want out of the unprofitable parts of it for sure, the direct result of that massive repricing. They expect their ACA enrollment to drop by about 2/3 in places where they couldn't get rates they felt were sustainable.
2/3 reduction in ACA membership. Intentionally.
Intentionally choosing to shrink rather than lose money or, subsidize those markets, that has huge implications, obviously, for consumers in those areas and for policymakers.
Definitely. And we're seeing a similar contraction strategy over Medicare Advantage MA, aren't we?
We are. They're projecting a total MA membership reduction for 2026, about 1 million members total across both individual and group plans.
1 million fewer MA members. That's a massive number. How does that break down? Is it all price related?
It's a mix. About 600,000 of that is from plan product exits, just discontinuing certain plans. But the rest is pressure from that disciplined pricing, which itself is driven by costs. They're still forecasting a pretty elevated trend for individual MA next year, around 10%.
Still 10% trended at MA for 26.
Yeah. And they were quite direct in the Q&A, basically saying the federal funding cuts V28, again, are, quote, degrading choice, access, and value to the consumer for the, 35 million people who rely on MA plans.
So they're framing these membership losses partly as a consequence of policy changes.
That's certainly part of the narrative, yes.
Okay, but the segment that sounds like the biggest ongoing headache is Medicaid.
Absolutely. That seems to be the most challenging spot right now.
Margins there are expected to fall even further in 2026, below the break-even level they're seeing in 2025. They basically called 2026 the trough year for Medicaid. Why is it still so tough?
The core issue, according to the executives, is funding misalignment. Simply put, states aren't increasing payments enough to keep pace with the actual medical cost trends they're seeing on the ground.
Especially where? Any specific cost drivers?
They specifically called out the huge growth in specialty pharmacy costs and also the continued high need for behavioral health services, which really spiked after the pandemic.
Right, so state payments just aren't catching up with those realities.
Apparently not. And because of that lag, they're expecting a really slow recovery in Medicaid, maybe 18 to 24 months, just to get back to a modest 2% margin.
18 to 24 months just to hit 2%. That's a long road.
A very long road for that segment.
Okay, let's shift to the overall financials for a minute. There was this interesting spike in discretionary spending in Q3, over $450 million. Where did that money actually go, and what does it tell us about their capital strategy?
Yeah, the CFO broke that down. About a third of it, roughly $150 million, was a one-time commitment to the UnitedHealth Foundation, so that's not really run rate spending.
Okay, philanthropic. Got it. What about the rest?
The other two-thirds, though, that went into investments in people, more resources for Optum Health's turnaround, and significantly into that accelerating AI expansion we talked about in Optum Insight.
Ah, so those are recurring investments.
Exactly. Recurring in nature and really signal their confidence or maybe necessity in pushing forward with the strategy despite the short-term pressures.
So with all this internal investment happening, what does that mean for things shareholders usually like, such as share buybacks or big strategic acquisitions, M&A activity?
They're paused.
Ah.
And this is pretty critical.
Paused entirely.
For now, yes, their debt-to-capital ratio climbed up to 44.1%. The company stated very clearly they are focused on getting that ratio back down closer to 40%.
Why is 40% the magic number?
It signals better financial health, more flexibility. It improves their balance sheet optics, basically. And getting back towards 40% is seen as crucial before they restart large-scale capital deployment like major acquisitions or big buybacks, which the market tends to reward.
Okay, so discipline on the balance sheet too. No big buybacks, no wager M&A until that ratio improves. When do they expect that to happen?
They specifically guided towards reinstating those historical capital deployment practices, meaning buybacks and strategic M&A, sometime in the second half of 2026.
Second half of 26. So more short-term pain or maybe prudence for long-term gain.
That seems to be the theme across the board here.
And speaking of 2026, just to wrap up the financial picture,
Yeah.
what are the last big headwinds they're still facing next year?
Well, it's the final year of those V28 cuts hitting the books. That's still a headwind greater than $6 billion for the whole enterprise.
$6 billion. Still huge.
Huge. Plus, they expect their overall effective tax rate to go back up to a more normal level, which eats into earnings. And like many companies, they anticipate lower investment income because interest rates are generally projected to decline.
So it's like a triple threat financially for 26. V28 final impact, higher taxes, lower investment income.
Exactly, which just underscores why every single operational decision we've discussed, the aggressive repricing, the network exits in Optum, the AI spending, it's all aimed at trying to offset that pressure cooker of financial headwinds next year.
Okay, so if we try to synthesize all of this, what's the big takeaway from digging into this Q&A?
Well, I think we've uncovered a company that's simultaneously executing a very disciplined, maybe even painful internal restructuring, especially within Optum, driven by these big strategic bets on AI and really rationalizing their networks.
Right, while at the same time.
While at the same time, externally, they're using contraction as a tool, deliberately shedding members in MA and ACA and pushing prices really aggressively in commercial, all to force margin stability back into the United Healthcare insurance segments.
It really is this less is more strategy, isn't it? Where profitability trumps sheer market share volume. That feels like a massive pivot for a company of this size and history.
It absolutely is. They're trying to fundamentally reset expectations, aiming for what they see as more sustainable, superior growth starting in 2027 after this tough reset year in 2026.
So maybe the final provocative thought for you, our listener, to mull over is this.
All right.
No, you take it. What's the lingering question?
Okay, well, it's this. The company is making these bold, potentially alienating moves. intentionally shrinking MA by 1 million members, cutting ACA enrollment by 2/3, aggressively narrowing networks in Optum Health, all in the name of better margins and future efficiency.
Right.
So the question is, will this intense focus on cost control and disciplined growth backfire in the short term? Will it alienate too many customers, too many providers? Or will that promise of long-term value, powered by integrated care and AI, be strong enough to win them back and fuel that market dominance they anticipate when this accelerated growth phase hopefully kicks in come 2027?
A fascinating question. Discipline versus alienation. We'll have to keep watching.